In my opinion, taxes are going to be the biggest expense for those who have been diligent savers throughout retirement. And the reason why is because they have most of their money in tax deferred vehicles in their 401k and their IRA. And so today's episode, we're going to talk about the 5 pillars of retirement planning and why you must take a tax focus on your retirement plan. Why you most focused, we need to be most focused on tax planning right now, because that's going to help you plan for the other 4 pillars that we're going to talk about, which include estate planning, income planning, investment planning, and healthcare planning. But it all starts with taxes.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So if you've listened to our content before, or you listen, ongoing, you know something about me, and you know that I absolutely hate taxes, and so much that I wrote a book about it, and it was an Amazon bestseller. And so if that's you as well, then this is going to be a podcast that's really going to speak to you, because you're going to be able to see the impacts of tax planning that, if done the right way and implementing the strategies the right way, can potentially save you hundreds of thousands of dollars in taxes throughout retirement, depending on how much you have saved up. And so, with most of the people we work with, they typically have $1 million or more saved up, and it's not outside their own possibility to save that kind of money in taxes. And the way we do this with our clients is through what we call our 5-pillar approach, which is all centered around tax planning. So tax planning is the foundation of what we do. Now, there's a lot of firms out there who may not specialize in tax planning. We get a lot of people who come to see us that are interested in working with us, and they go, wow, our advisors never brought this up. And we always ask them, is your advisor an investment manager, or is he a comprehensive retirement planner? And typically what we hear, oh yeah, he just manages the investments, that's all he does. They don't bring up any tax strategy, they don't help us with estate planning, they don't help us with income planning. They just manage the investments and tell us when the market's down, just hang on tight, it'll be good moving forward. And when it's all good, they just tell us it's doing good. They talk about like all these weird investment terms like beta and alpha and all this stuff, and I don't know what it means, but it seems to be doing good. The market's been up the last 20 years. And I'd argue, yeah, it's probably done really well over the last 20 years. But again, you were in probably a different phase of life the last 20 years. You're probably in the accumulation mode, where now you're probably in the distribution phase, which is retirement. And it's a different phase when you go up the mountain than it is going down the mountain. We always say, what got you here may not get you there. And so the type of planning that you're looking at in retirement is going to be much different. And that's why we suggest that most people should take a tax-focused approach, especially if you have more saved up. Because again, anytime you take out money from that tax-deferred investment, you're going to have to pay taxes on that. So we need to make sure that we have a plan here. And so what I'm going to talk about in today's podcast is really just showing that importance of tax planning with your retirement plan and how it plays a part into each pillar that we believe sets up a complete retirement plan. So, we follow the CFP board, which the CFP is a certified financial planner. So that's the gold star industry, credential basically. So if you have that, it shows you have the expertise, the experience, and all of that fun stuff. And all of our advisors either have that or are in a training to get that, because we feel it's so important. Because if you're truly going to handle someone's life savings, you better know your stuff. You better be willing to go the extra mile to show that this is important to you and you're serious about learning to be the best. And so we follow their credential of here's what a complete financial plan is. And they have multiple different areas that you must pass tests on to become a certified financial planner. And in those 5 areas, it's tax planning, it's investment planning, so investment management, it's income planning, how do we get that income for life, healthcare planning, how do we prepare for long-term care and Medicare and things like that. And then the 5th thing is estate planning, is how do we plan for those end-of-life decisions, to plan for when we're no longer here, to make sure this wealth transfers to our kids, make sure it transfers to our wife, maybe charities, whatever your goals are, make sure that happens in the cleanest way possible. And so let's touch on how taxes play a part in each of these pillars. And so let's just start off with the income plan. With the income plan, we always are talking with people about, it's not how much you take out of your investments in retirement, it's how much you keep. I mean, you can take out $100,000, but if you only keep $70,000 because taxes ate the other $30,000, are you going to be okay with that? Versus, what if we can take out $100,000, and what if we can keep the $100,000? Do you think that may help us last that income, make that income last longer. And so those are the things that we're looking at when it comes to tax smart income planning, is being smart about the distribution and the way we're taking out money. This is a big reason why people work with us, is because they don't know whether to pull from their Roth IRA, their IRA. They don't know when to pull out, take Social Security. They don't know their pension, of what to do there. Should they take the pension? Should they do the plop? Should they defer it? There's so many decisions to make in income planning. Should we take out money from our bank account? Should we take it out of the IRA instead? What about this big old brokerage account we have that's non-qualified, that has all these gains and capital gains? Do we want to pull out that? Do we want to defer it? What should we do? And what do we do if the market's down, right? So all of this plays a part in income planning. It's a huge part to a retirement plan. And so what we're always trying to work with our clients of is, how do we be tax smart and get ahead of it? How do we be proactive? And what that consists of right now is, maybe we're looking to do more things such as a Roth conversion, where we're moving money from all of our tax deferred accounts over to the Roth, so that when we get to the point of taking money out of our investments, we have the choice of which account we take it out from. But more importantly, we have the choice of if we want to pay taxes or we don't want to pay taxes. And this is also going to play a part in when you take Social Security, right? Because Social Security is taxable. Again, tax planning is the theme of today. It's going to be taxable depending on your income. And so if your income is higher, the majority of your Social Security is going to be counted as income. And that means that your $3,000 check from Social Security that you got, all of that is not in your pocket anymore. Uncle Sam's going to get a chunk of that, and then you get the rest. Versus if we can keep your income lower by maybe taking withdrawals from a Roth, so you don't have to eat ramen noodles and live under a bridge in a cardboard box. You can still live on that $100,000 you need to live on each year. But what if we pulled $40,000 out of Roth there, and you didn't have as high of an income shown in your tax return because that Roth is tax-free? Well, now some of our Social Security could actually be tax-free as well, and now we're not having to pay as much all-in taxes. And so maybe at the beginning, like I said, we're taking $100,000, but we only got $85,000 of it. Well, what if now we can take out $100,000, maybe we can get $95,000? What if we can get another $10,000 of alpha from your investments because of tax planning, because of paying less in taxes? All about being strategic about what we do. And typically we joke with our clients of, hey, we're able to get you another $10,000 of income every year moving forward is what we're projecting. What are you going to do with that $10,000? Because we ain't just saving this money and doing great planning just so you can sit there and stare at it. It's got to be purposeful, right? It's something we do with all of our clients. We call it a dreams, mission, values conversation. You've done your work up to this point. You've saved enough money. What do you want to see with this money moving forward? Do you want to go on another extra trip? Do you want to take the whole family on the trip now that you have an extra $10,000? Do we want to maybe retire a little earlier now, knowing that we're going to have all these savings moving forward? Do we want to upgrade the home, knowing that we have this more comfort? Do we want to get a second home, right? So all of these are decisions that you now have the ability to make because you've been tax smart and implemented strategies correctly to get there. And so the income planning is a big one. Many people, especially if you have all different types of investment accounts, it can get really tricky to make sure you're maximizing that. And you probably could do it on your own. I mean, anyone can take money out of their investments, but the question becomes, are you truly optimizing it? Do you have the right software to ensure you're making those exact decisions to make sure your money lasts as long as possible? So if you don't have a plan there, I would highly suggest that you're getting help. Don't just go through retirement and say, yep, I'll just take from this account. That sounds good. You can be really smart here and save a lot of money. So that's the first pillar. The next pillar I'll talk about is the investment pillar. So again, this goes hand in hand with the income plan, because typically for people with income, they're taken from Social Security and investments. And so from the investment standpoint, we need to understand how much do we have in each bucket, right? How much investments do we have in tax deferred? How much do we have in tax free? And we have to find the optimal balance there. For many people, it's not 100% in either bucket, right? We want to make sure that we have a balance. Maybe it's 50-50, maybe it's not. It's depending on your situation. But we need to have the control and flexibility to choose which bucket we're going to take out from in retirement. And then the other question, the other concern here comes from taxes of, which bucket do you take out from? We have tax deferred bucket, we have tax free bucket, which is Roth typically, and then we have the taxable bucket, which could be either capital gains or ordinary income when you take that money out, right? So as we know, bank accounts, you have to pay ordinary income tax on your investments every year. For capital gains, you've got to pay capital gains on dividends, and if you take money out, you get to pay capital gains as you sell things, and that's all going to impact your tax situation, and that's going to impact your investment return. So we always tell people, yeah, 10% investment return is great, but actually how much of that did you keep after taxes? And again, if we can pay less taxes, now your investment return at 10%, maybe now you can get closer to actually seeing that return over time because you're not going to have to pay your partner, Uncle Sam, as much there. And so just understanding the allocation of those three investments, right? We call it tax allocation is ultimately the buzzword for that. Is, hey, where's our money at in these three buckets, and where can we make sure we want to put them? And so everyone always wants their money in tax-free, right? Now, is it wise to have everything in tax-free? Not typically. It doesn't make sense to move everything there. But we typically want to see how can we get more money to the Roth. And so, for example, if you have the money in a bank account and you're paying ordinary income on that, well, you could be paying 20 or 30% plus in taxes every single year on that growth. Well, what if you're still working and you can contribute to a Roth IRA? So let's say you have $100,000 in your money market account at the bank. Well, if you're married and you're over 50, you can put $16,000 of that money into Roth IRAs. Now you can get that $16,000 growing tax-free instead of having to pay taxes on that 20 to 30% ongoing. So that could be one adjustment that you make. Or maybe instead of having that money market account, maybe you're maxing out the Roth, but maybe you're looking for something additional. Well, maybe if we take that money and we move it to a investment, a stock or a bond, something, a bond fund or a stock fund or something, that now it can grow at capital gains tax rate versus ordinary income. Maybe instead of paying 20 to 30, maybe now we're only paying 15% on that capital gains. Or maybe in retirement, we could wait and let that, invest in a tax efficient fund like an ETF where they're not going to make a ton of trades so that all this gain continues to grow and accumulate. And then when we get to retirement, there's something called the 0% capital gains tax bracket. So if you're not aware of that, definitely worth looking up, that if you sell it off and your income's under a certain point, you don't have to pay any tax on that capital gain. So that can almost turn into a Roth at that point if we just are smart and look ahead of what does this plan look like. And so that's going to help you there. The other thing that we always look at for investments is, hey, the tax location of the investments. So for example, if we're seeking a lot of growth in our investments, we're going to be more aggressive, stock market type approach. We probably want those assets in a Roth, because if we're expecting that to grow the most over time, let's make sure it's tax-free. Versus if we're saying, hey, we want this to be a protected bucket, we want this to be more protected for income over the next 5 years, well, maybe that's okay to have in tax deferred, and maybe that's okay paying ordinary income, which is the highest tax rate in most cases. Maybe that's fine because we're not going to see as much growth there, but we still need that protection, but it would make more sense to have it there versus a Roth if we're not going to see as much growth over time. And so just being tax smart there can add percents of return to your portfolio every single year. So again, the whole point of this is just being very diligent. And again, if I'm talking all this stuff and you're like, man, I'm not sure if I'm doing this and I need to make sure I'm getting this done. How do I get this done? Go work with a professional. Go work with someone, whether it's us or someone else that can help you get these things done to ensure you're in the right position is ultimately what we're recommending for people. So that's the investment pillar there. Again, there's many other things to look at there, but those are just some to give you a highlight of what that looks like. The third pillar here that we see plays hand in hand with the tax plan is a healthcare plan. And typically there's going to be a few different reasons why this can be important. One is for Medicare premiums. So as we know, Medicare premiums are based on your income. And so the higher your income, the more you're going to have to pay for Medicare premiums throughout retirement for Medicare Part B and D. And this actually starts at age 63. So even though you don't get Medicare until 65, they're going to calculate that 65 premium based on your 63 income. So this is something you have to be thinking ahead on. And so as soon as you reach 63, you got to make sure you're aware of how this all works together. And so how this plays a part in tax planning is, again, let's say you're expecting to have huge RMDs in the future at 73 when you have to take out required minimum distributions from your tax-deferred investments. Well, if you take out money from those, that could bump up your Medicare premiums. Well, maybe if we have that money more in Roth rather than all in tax-deferred and we started doing things like a Roth conversion, for example, now we can lower our income. Again, tax planning allows us to do that, and now we don't have to pay as much in healthcare. So not only are we not paying as much in taxes, we're also not paying as much in healthcare premiums just by simple tax planning is what that does. So again, that's very important to look at based on your situation. And then the other thing for healthcare that we're seeing be a big concern is long-term care. Now, depending on, regardless of your situation, this is probably going to be something you're going to need to be planning for. And typically people are thinking, hey, long-term care insurance, that's what I'll do. Or maybe I don't like long-term care insurance. We're not typically recommending long-term care insurance at this point in time. That doesn't mean you shouldn't look at it. Just for our clients, we don't necessarily feel like it's super valuable right now for them. That could change. Again, don't take that as advice, but just something to consider. But if you do need to, what most of we're seeing people do is self-insure for long-term care, making sure their investments are structured in a proper way so that, hey, if the market goes down, they're going to be protected. They're not going to have to take out the $50,000 to $100,000 a year for long-term care from that down market. But also, hey, if we have to take out $50,000 to $100,000 from our tax-deferred investment, what tax bracket is that going to put us in the future? Is that going to raise Medicare premium tiers? Is that going to make Social Security more taxable? And so that's all going to help us make that decision of, hey, can we pull from the Roth versus tax deferred? What about the taxable bucket? What's going to be the most optimal way to take a huge distribution from our investments to ensure we're not overpaying in taxes? And so any large expense planning is going to be a big concern in tax planning, but especially long-term care, because we know that 75% of people are going to likely need that in retirement. And so that's a big one to plan for. And so the final pillar here that I want to discuss is that estate plan. Now, I always phrase this one like this. Do you really want Uncle Sam to be the beneficiary of your life savings? Or would you rather have it be your spouse or your kids or someone that you love, right? And so what typically people tell us is that, they like paying their taxes. They don't mind paying, their fair share. But I don't think people like to overpay in taxes. And I also don't think that everyone thinks the government's the best steward of our tax-paying dollars, which means that people probably aren't donating more taxes than what they're required to pay each year. And so if that's you, you're really going to want to make sure you're planning now and being proactive to ensure that Uncle Sam doesn't take more of your life savings. Because I can tell you that the current rules that they're putting in place is making it less advantageous to transfer wealth to the next generation. For example, they've changed the rules on a stretch IRA for an inherited IRA from it used to be able to take it over your lifetime. Now your kids have to take it out over 10 years, for example. And what that may do is increase their tax brackets at a future time when tax rates are probably going to be higher, and now they're going to have to pay more in all in taxes, and your life savings is not going to go to where you truly wanted it to go in all. So these are the things that we have to look at here. And then again, if your goal is also maybe you want to be charitable, you want to leave money to a charity, whether it's now or when you pass away, there's specific strategies that you need to utilize to save money on taxes. Maybe a donor advised fund, maybe a qualified charitable distribution, maybe understanding the fact that if you leave your IRA to a charity, that's tax-free. And so if our clients want to leave something behind to a charity when they pass away, we're typically putting the beneficiary as a portion to the charity, and then we'll leave all the other assets to the kids, for example, if that's their goal. For example, we don't want to leave the Roth to the charity because that's already tax-free. We don't want to leave a life insurance policy to charity. That's already tax-free. We don't want to leave a non-qualified account to the charity because that's going to get a stepped-up basis. We don't want to leave the house to the charity because that's going to get a stepped-up basis for when you pass away if you were to leave it to your kids, for example. So as you can see, you got to be really strategic about what you leave behind to charities, what you don't. But again, that's all part of an estate plan of, hey, what do you want this wealth to do? Where do you want to leave this wealth? What do you want to do with it? Do you want to maximize the amount to go to your kids, right? If you've really been a diligent saver, something you're going to have to worry about is what's called the estate tax. Now, that may not be a concern right now, but here in 5-10 years, it's got to be on your radar because I expect that number to come down significantly. And what the estate tax is that if your wealth is over a certain limit, you're going to have to pay a 40% tax on anything above that. And if you go back in history, that's been $1 million or even less, that if you had over $1 million, you would have to pay a 40% tax or even more on that wealth above that point. And so if you have $3 million, well, that's $2 million over that limit. If that was a hypothetical example, you're going to have to pay $800,000 to the government when you pass away. Not you, but your kids will. And that means that they get that much less wealth that you've accumulated. And so if you really want to accumulate and give generational wealth as time goes on, this is something you have to be aware of. Now, the good news is that you can get ahead of this and you can plan and you can utilize these exclusion limits that we have right now that are so high, and you can make sure that you can protect this wealth to ensure that more of this goes to your family and thus to Uncle Sam. And so, again, it's just all about being proactive, and this is something we really got to have on our radar, knowing that in 2 short years, in 2026, that annual exclusion is going to be cut in half, and now more people are going to be likely, subject to this estate tax consequence here. And then I'm ultimately thinking that limit's even going to get cut more over the years to come. And so again, just something you really need to plan for. And again, another example of how tax planning is the foundation of everything. And as you've seen here today, each of these pillars, we have to look at the tax plan in order to make the right decisions of how we invest and how we plan for healthcare and how we plan to leave money behind. But if you just take taxes out of the equation, you're going to miss everything we talked about today. And again, that's why our biggest advice is if your advisor's never talked about taxes before, if they don't look at your tax return, if they haven't even mentioned a Roth conversion, if they haven't talked about tax rates increasing, I would encourage you may want to look to get a second opinion to make sure you're on the right track, because again, taxes are going to be the biggest expense in your retirement for most people who have been diligent savers, and there's the most opportunities in tax planning. You can save more money on tax planning than anything out there, in my opinion, and it's the most valuable piece you can have in a retirement plan. So again, my advice is to get help from someone who can help you there. And if you like what you hear from everything that we talk about, if you feel that we could help you moving forward, then go ahead and reach out to us. You can either schedule a time on our website if you're listening to this podcast. So if you're watching from our YouTube channel, just go into the description below and you'll be able to schedule a time with us. And we can see either if we can help you or at least guide you in the right direction to see where you're at. Just to ensure you're not missing anything is ultimately the goal. So hopefully that's helpful for you. Again, the 5-pillar approach is extremely important to have that comprehensive approach. But again, you need that tax focus. And if you look at our 5-pillar logo here on our process that we do for our clients every single year, you'll see that taxes is the biggest pillar there. And that's done for a reason. And that's because everything plays off of that, and that we must have that foundation set. Every year we're looking at our client's tax return. Every year we're making decisions of what to do with their tax plan. And so, again, just extremely important to do. So with that being said, let's go ahead and wrap up today's episode, and we will see you on the next one. Enjoy this lovely day we have here today.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.